Welcome, everyone, to the Allocation Agenda podcast. I'm Steve McDonald, your host. And today we've got a very special guest on with Gary Tom. Gary, not only have you spent over 20 years with Wilshire, but you've done pretty much everything in equities. You've been a primary growth analyst, international growth analyst, value growth analyst, you name it, you've done it. And today we're going to be talking about the impact on trillions of dollars that are under management and some of the issues that you think are outdated. In fact, they stem from an act done back in 1940. It's called I brought it up over here because I couldn't believe it when you brought it up to me. It's the Investment Company Act of 1940. And I'm going to have you tell us what that is and how it's negatively impacting the industry today. And not a lot of people are talking about it. But before we get into that, I'd love to hear a little bit more about your background. If you could just explain a little bit more about your background before we get started.
Yes, Steve. As you mentioned, I have been at Wilshire for a little over 20 years. I have really covered pretty much everything within the equity landscape. I am well known across all of the asset managers and have done quite a bit of work in terms of trying to improve the outcomes for our clients, not just ours, but the entire industry in general. And as you mentioned here, really wanted to focus on the diversified fund role. It's an issue that I have been focused on for the last couple of years, actually, really trying to map out which managers are subscribing to it, trying to get managers to pull off of it as well. It's not just the mutual funds that are being subjected to this rule. It's also many managers are managing their separate accounts in the exact same manner. And a lot of investors just don't realize it. In terms of the diversified fund rule itself, there's a couple of different stipulations on it. But the major one, which I would like to focus on today, is managers are restricted from investing over 25% at cost in 5 names. As the indices have gotten more and more concentrated over the years here, particularly as we've seen a mega cap rally over the last 13 plus years. And this has become a greater headwind to active management within the large cap growth space. While it's certainly an efficient asset class, as you can imagine, restricting yourself to 25% at 5 names when the benchmark you're being compared against has over 43% in its top 5 names and over 63% in its top 10 names. Restricted yourself 25% at cost in 5 names. This is not just a couple managers we're talking about. This is the industry. There's only a handful of managers that have even come off of this. And it's an extremely expensive process to proxy vote. And even having the right asset base, that proxy vote will actually go through it.
Yeah, first of all, I'd like to hear the pros and the cons. Why was this done in the first place?
I don't think there are any pros, Steve. The only pros are the people that have paid to get off it, whether it's a T. Rowe Price, JP Morgan did it recently, Fidelity. There's a couple others like Invesco. I think Boston Advisors has a mutual fund with Knights of Columbus, maybe a couple others. But for the most part, the entire industry is being held to this standard. And I can name names if you like, but I'll leave this in your hands.
So give me some examples. And you don't have to name names, but tell me some stories of why you think this is so damaging and so widespread. Let's start from there.
Okay. You want a couple of stories? I will tell you that over the last year, after I confronted one manager and told them I offered them a focus list spot if they came off of the diversified fund rule, they refused to and lost the number 2 on a $50 billion plus platform. I will tell you that one of the bulge bracket asset management firms, a PM quit several years, maybe 5 years before he actually retired. And I believe this had a significant impact on that. I will tell you another asset manager who had told me in November 23 that NVIDIA was more valuable than Apple, when at the time it was 1.2 trillion, 40% of its market value. He brought in over 100 billion in assets. He increased his strategy asset base by over 100 billion in less than 2 years. He got capped out. And this was an extremely impactful situation, despite outperforming last year, because he was capped out on NVIDIA. And as these assets came in, he came further and further underweight that day. Unless you want your assets to be completely mismanaged, you should at least know about this rule. Whether you go passive or not, that's the issue. But if you look at the strategies today that are offered in a non-diversified format, they are either extremely bloated, whether, as I mentioned, the T. Rowe Price, Fidelity, JP Morgans of the world, or quite frankly, they're just too concentrated. One big issue that I've come up with as I've been approaching managers with this role is really they don't want to spend the money to get off of it. It's an extremely expensive process. And on top of that, they haven't really had the incentive to get off of it. And what we have seen here is really a launch of new vehicles in the space, in the large growth space, have been really targeted at kind of your active ETF formats, which tend to be even more concentrated and are a little bit more niche, not really all weather, if you will. So that's become a major issue within the industry and put in some input in terms of creating a product that the industry would like, a non-diversified but yet diversified strategy that's not going to blow up on you. Unfortunately, it's been a very difficult trudge on my side. I was hoping to get a stampede going and been a little bit slower than I anticipated from that perspective.
How is this impacted? So this rule's been around since 1940. You've been working in the industry for over a couple of decades. Obviously, you've had a lot of success. A lot of firms have had success. How does it impact, if it's to stay in place, which doesn't look like it's going anywhere, how does it impact the long-term strategies that, as an analyst in a firm, that you're bringing to market? How does it limit your creativity, your innovation? How does it impact you as an analyst?
Well, Steve, as I mentioned before, having the right compensation, alignment of interests are extremely important. These managers are being compared unfairly, really tied with a hand behind their back with the diversified fund rule. I was compared the same way. I needed to outperform my benchmark with the options available to me. And when the options are just really bad, it becomes an issue. And then trying to shake the tail, really get our clients and knowledgeable about this rule and moving them into either a non-diversified version of that strategy or a different firm and process. As a result, people don't like change at the end of the day. It creates issues internally, battle against, even if it's the right thing.
There's one thing that happens when conversations happen behind the scenes. Sounds like you've been having a lot of conversations behind the scenes with a lot of different people. If you could just articulate, so we're getting a lot of your point of view here, articulate some of the points of view of the people in the diversified fund rule that you're talking to and what their point of view on it is. Like when you have those conversations, what's the result? Are they equally as frustrated as you are?
As I mentioned, I did have one senior PM on a $50 billion plus platform leave last year, or we've seen a PM that retired many years before he actually left the industry as a result of it. I'd say I put a lot of pressure on one firm that actually did come off of it last year. Another major one is highly considering it for this year. So if they do, I'm going to take credit for it, but I won't name names for that perspective. But as I've brought this role up, they're looking to want, I told them basically that either you shift your separate accounts that we have invested in into a new composite so that you can manage our money properly, or we're going to leave you. If there's no other options within your firm, even if they were to separate the separate account in that manner, it wouldn't just be our clients. I'm trying to impact all the clients out there that aren't even aware of this issue that's been going on. We did see one manager that did come off the roll last year that I guess they had separated into their separate accounts into a new composite and merged them back together. And when I found out you could do this without any approvals from clients, etc., that's when I really started to push managers to do this. And I'm really hoping that some non-diversified products are actually launched as opposed to just active ETFs to give them another vehicle because they're too concentrated to really be an all-weather product and the best for our clients.
For those asset management firms that you're talking about, what would your recommendation be? What's the first, second, third step that they need to do if they want to move off of this?
First step is to really, I would say, analyze their asset base, make sure that if they were to go down the proxy route, they can get the proper votes. I believe it's 50% in order to come off for the proxy vote to be approved and for them to come off the roll. So I would analyze your client base, make sure that you do have the client base that you can actually, if you wanted to pursue that, would actually be able to come off, because I have heard from some bulge bracket firms that they don't have the client base to get the proper proxy votes. And then really just pursuing that proxy and removing that non-diversified status. Even if you remove the diversified status, you're still limited to 5 and 50% in your top 5 names. With the benchmark at 43% plus, as I mentioned in the top 5 names, you got a little more leeway, which is nice, but it's still pretty restrictive even in that sense, especially And really, as I think I mentioned before, but these managers are now stuck in their holdings. These names have appreciated quite a bit, and you have to sell massive amounts to drop below that 25% threshold in those five names, and then to reallocate it into a new name. It's extremely restrictive. Even if you expect a smaller cap rally, a smaller cap rebound, which I do, these managers are now stuck in their names and extremely active no matter what.
So what's the message for, you've talked about the message for asset managers. What's the message for the large institutional funds that are hiring the managers?
I would certainly say talk to your large cap growth managers, figure out if your strategies are being managed ineffectively, are being managed to the role, and request either identify a solution that the manager has that's non-diversified. If you're in a separate account, demand that you're split into a new composite and that your assets are no longer being held to that mandate, or just finding another manager at the end of the day.
So if you were running an asset management firm, and we're all looking for a competitive advantage, we're looking for reasons why more institutional investors are going to be working with us.
They're already working with it. It's just whether or not they're knowledgeable of it and they do anything on their side, or the asset managers do right.
Is it in any shape or form something that should be brought up proactively by the asset management firms?
I absolutely believe it does. We have seen one extremely large index manager have gone down that legal route and are now allowed to have their indices, passive indices that are managed to, say, the Russell 1000 growth index. They can be non-diversified or diversified based upon how that weighting of that index. This is only for passive products and not for actively managed strategies. I believe that there's no reason why managers should have to pay $10 million plus to proxy vote to come off of an ineffective rule. This should be brought up to legislation or the SEC to really abandon that rule where it doesn't make sense, in my opinion. But I'm not really a legal person, so I wouldn't know.
Out of your entire industry, Gary, tell me something that you are incredibly proud of that you've been able to accomplish. We've covered a lot on this podcast. What's the single most important message that you want to leave people with?
The most important message that I would like to leave viewers with here is, if you have any active large cap growth exposure, really reach out to your managers, make sure that your assets are being managed in the proper manner, that they are not being held to this diversified fund rule, and especially on separate accounts, demand that your assets be broken into a separate composite that are managed properly. I would say, in terms of things I'm proud of, there's actually quite a bit. I've accomplished quite a bit in the industry, but being really kind of the pioneer in diving into this, there's a couple others that know about it in the industry, but nobody has really mapped it out like I have, that have put pressure on these major bulge bracket firms that have gone up to their board, that are actively considering making these sort of changes. That in general, there's been quite a bit. It have impacted all of our major clients here last year. Even clients that didn't look that much at our research overall, been called into meetings with all the major ones, discussing my opinions, leading to a number of terminations, not just in the large growth space, but being able to back up my research of why I feel. Say there was a small cap growth manager with about 800 million in assets through one of our clients. They had lost a member of their team, a biotech analyst, which is an extremely rare skill set in this space. Try to slide over a cyclical analyst who's a very good analyst, but in my opinion, it just doesn't work. And they were going to hire a junior analyst to backfill that role. I told them, listen, that's not going to work out. It's not going to solve your issue. And they refused to look into a more senior analyst. As a result of that, I downgraded them. Another firm that went public and really didn't have an equity recycling program, or still does not. I brought that up as a number of their senior investors are retiring in that equity allocation for existing to dwindle in that perspective.
I would like to hear your point of view on, this is a relationship-based business, and the relationships between the management firms, there's relationships between the institutional investors, there's the planners, the advisors in the middle. Do you have any advice on how we create better relationships in between all of those? We spend a lot of time talking, but we don't spend a lot of time talking about those relationships and how to make those relationships better.
It's not just the industry that's a relationship business. It's life in general. It's your network of contacts and how you utilize them. That's going to give you strength within the industry and really build up that rapport. I would say knowing your truth, standing behind your convictions, regardless of the headwinds that you may face because of it, is extremely important. And that builds respect across the industry, whether or not you get it internally or not. But the work that you do, the connections that you make are going to follow you across your life. And it's going to open up opportunities for you. So make sure you're networking, that you're doing things the right way, and people will come to respect you at the end of the day for that.
Fantastic. Any advice for the investment management firms in terms of their particular relationship with the institutional investors and then vice versa?
I would say at the end of the day, do what's right for your clients. Whether or not it might hit your profits in the short term, it's going to be beneficial in the long term. You should have better performance if you're actually good. And that will lead to asset inflows that you should be able to make up for it. But at the end of the day, doing things the right way, not having to fight with one hand behind your back and fighting on a level playing field is extremely important.
Here's what I'd love to do. I'd love to know, what is your advice for other analysts in the industry? It's very rare that we get to have somebody on to the podcast that has accomplished as much as you have. If you could impart some of that wisdom to them.
I would say always hold true to your values. It's really taking pride in your work. You're not doing this necessarily for other people, but a lot of it's for yourself at the end of the day. So this is where you're dedicating a lot of your hours. Stay strong in your conviction. And even if other circumstances or other people are not striving to that, even if it faces headwinds, stand strong in your conviction and know your truth.
Here's something that I know is going to happen. We're going to get a lot of questions. If I give out maybe a link to your LinkedIn profile that people could reach out.
Yeah, absolutely.
Fantastic. One of the major benefits of this podcast is that we can bring in different perspectives, raise questions, identify areas of concerns, things that need to change, bring a voice to it. And I think you did that in spades today, and I really appreciate it. I just wanted to say that it was a pleasure having you on the podcast here today.
Absolutely. And thank you for having me, Steve. I really appreciate it.